Hello, everybody, and welcome to our show today. I'm really glad everybody could join us. So today we are going to be talking about how to read an Experian business credit report. So we're going to be diving in. We're going to be kind of looking even at an Experian business credit report to show you the different aspects, and then going through for about 30 minutes or so, and just kind of giving you some of the details that are on your Experian commercial or Experian business credit report. This is very important because look, if you've never looked at your business credit reports, they are very, very different than consumer credit reports. And the reason I wanted to talk about this topic today is because I get so many questions relative to this topic of why is this on my report this way? What is this? Why is my available credit missing, et cetera, et cetera. And today we're going to decode this. I'm going to show you the scores to look for on your report, the sections of your credit report, what these sections mean, things that affect your scores, things that affect your profile. So then that way you can construct a good business credit profile with Experian from the ground up. Now, this is very important because Experian is one of the most used credit reporting agencies by credit issuers. So people issuing business credit cards look at Experian more often than the other reporting agencies typically. So what you learn today will be the key to getting the highest limit business credit cards that you're going to get when you're out there applying. So for those of you that don't know me, my name is Ty Crandall. I'm actually the CEO here at Credit Suite. And at Credit Suite, this is what we do. We help companies obtain business credit. We help them through the process of building business credit. To date, we've helped, I think, now over 15,000 people. So we know a lot about this topic. And what we're going to talk about today is kind of a combination of the knowledge that we've accrued along the way. You'll also see that I do have a link at the bottom of our slides, creditsuite.com/monitoring. At creditsuite.com/monitoring, you can actually get credit monitoring with Dun & Bradstreet and Experian for only $24. It saves you about $200 a month, it actually saves you about $180 a month because it's about $210 to get it versus the $24. And that's through our NAV integration. So feel free to check out that link. So business credit, remember, we're talking about credit here that's in a business's name. So when I'm talking about Experian today, I'm not talking about your consumer credit reports. What you're going to find on your consumer credit reports is significantly different than business credit. Remember, we're talking about business credit today, the credit that's tied to the business. It's the business's creditworthiness, not the business owner's creditworthiness. The scores we're going to talk about today are also going to be very different than what you're going to find with consumer credit scores and things on your consumer credit reports as well. So there are three large credit reporting agencies in the business space: Dun & Bradstreet, Equifax, and Experian. So Equifax and Experian, we refer to those as Equifax or Experian Business or Equifax and Experian Commercial. Those are divisions of Equifax and Experian. Although TransUnion does do some stuff in the business space, even in places like Canada, they're really not popular down here in the United States. So Dun & Bradstreet is the main credit reporting agency that we deal with in the United States, and they're probably one of the main ones that most people in other countries, if you're watching, are exposed to as well. And there's also a FICO SBSS business credit score, which you won't necessarily see on Experian's credit report, but I do want to reference this score because it's essential to getting business loans with SBA or through SBA. So it's something you should know about. If you want more on that topic, you could definitely go and listen to our podcast where we've talked more about this on iTunes, or check out our YouTube channel where we have videos on there about that topic as well. So Experian, like the other reporting agencies, focuses on getting the highest quality data and analytics to help businesses better assess risk. So a lot of people forget what the business reporting agencies do. What reporting agencies do in general. TransUnion, Equifax, Experian, Dun & Bradstreet, Equifax, Experian Commercial. All of these reporting agencies, even LexisNexis, all of their job is to gather data and basically sell the data to anybody that will buy it. So never forget that. The reporting agencies, the heart of what they do is gather data, and then they get the data together and they add scores and different things to it to help people better assess risk. So people that may lend you money, institutions that may issue you credit cards, that's where this data is being used and where Experian is typically supplying it. Now, they possess a massive consumer and commercial database. They manage to help businesses obtain the best and most up-to-date information. Experian has about 27 million business records on file. To give you an idea of where they stand in the hierarchy, Dun & Bradstreet has about 220 million. So easily 10 times more records on file than Experian, but Experian is still bigger than Equifax in this space. And then they extract significant extra value with this data by applying their own analytics and software to help, again, typically credit issuers and lenders who are supplying money to you better assess whether you're worthy of being issued that money, whether you get approved or denied, also to help determine the rates and terms you'll pay, and also determine how much you're going to get approved for. You're going to see all those things today on real commercial credit reports. We are going to talk through what this looks like and how the information we're going to talk about today directly affects whether you get approved or denied financing, the rate and term you'll pay, and how much you'll actually get approved for. So Experian uses both consumer and business credit information to both together to gauge risk. And they basically claim that by combining personal and commercial credit information in one report, they provide a complete picture of the creditworthiness of the small business. Now, don't worry. They do have what's called a blended score that does take into account your consumer and your commercial score. It's not popular. They're typically using an Intelliscore Plus that does not take into account your consumer credit. But I do want to reference they do have a score that takes into account your personal and your business credit quality. Okay, and Experian's listed on the London Stock Exchange as EXPN. So why did I list this? I think it's interesting. A lot of people think of the reporting agencies of being right here in the United States. Dun & Bradstreet's headquarters is here in Short Hills, New Jersey. Equifax is right out of Atlanta, but Experian isn't in the United States. They're actually traded on the London Stock Exchange, and their corporate headquarters is overseas as well. I just find that interesting. A lot of people don't know that. So the typical Experian business report normally contains a business registration and ownership details. This could be your name, the phone number, the address of the business. It contains addresses. It contains how fast the business is paying its bills. Okay, and this is referred to as DBT, or days beyond terms. Now, here's one of our client Christine's credit reports, so you can kind of see what this looks like. I'm going to probably just do an overlay. For those of you listening on the podcast might not be able to see this, but you will be able to see this here if you're watching. So you can see here that here's the actual information about the business name. We can see the business's identifying number with Experian. We can see the business's address and the business's phone number. So we see those business details. How fast the business is paying its bills. This is called days beyond terms, which means how late is a company paying beyond the terms that they are actually permitted or they actually should be paying. And we'll see days beyond terms in several other sections as well, including summary sections of accounts. We also see days beyond terms here in this section too. So we can see DBT. So on these credit reports, when you see current days beyond terms, predicted days beyond terms, monthly average days beyond terms, highest DBT previous 5 quarters, 6 months, just know that DBT refers to as days beyond terms. A credit risk score, and actually your credit reports will have many different risk credit scores. The biggest and most popular of which is called Intelliscore Plus. And Intelliscore Plus basically looks at how you pay your bills. About 85% of this score is made up of how you pay your bills. It actually breaks down that about 50 to 60% of the score has to do with payments and balances that you have. So your balance is calculated into the score. 10 to 15% of its utilization. 10 to 15% derogatory items, 5 to 10% your historical behavior, 5 to 10% age, industry, and size. So if you really break that down, about 85% of your score really has to do with how you pay your bills. The other factors really have to do with the size of your business, your industry, and your utilization. So you're going to see that here, the main score used to determine approval with Experian, that IntelliRisk score. Any court judgments or any public records, we should say, in all. So if you have any public records, you can see right here, payment and legal filing summary section on the credit report. It says how many bankruptcies, how many tax liens, how many judgments, legal filings. Commercial credit reports are very different than consumer. Commercial credit reports have lawsuits. Whether you file a lawsuit against somebody else, your business, or somebody else files a lawsuit against your business, that is listed here under the sum or the actual sum of legal filings. UCC filings just indicates that you have loans outstanding. So all this information is available on the business credit reports too, and a history of companies' financial performance, basically how you pay your bills. And that's what this looks like here. So we can see every different type of account on a business credit report and how you pay. Are you 1 to 30 days late, 30 to 60, 60 to 90, 90 days plus? What kind of balance do you have? What kind of recent high credit limit do you have? Now, what's interesting about commercial credit reports is they do not say credit issuer names, right? So if you pull your consumer credit report and you have a Target card, it says Target, but it doesn't say that in your commercial credit reports. It gives you categories, or what is referred to as a business category, or really the industry. So hardware is what could be listed here for Home Depot or Lowe's. Office supplies could be listed for Staples or Office Depot. Packaging could be listed for a Uline type of account. This is why you want to keep up with your commercial credit reports, because it's hard to dispute if you don't know which credit issuer it is that has the information reported. So as you accrue new credit, as you get new credit that reports, you want to keep an eye on it, even keep track of what that credit is, because again, it won't tell you the credit issuer's name. And then it has this summary section that summarizes that too. As we just mentioned, the days beyond terms, how many trades you have, how many you have in collections, the 6-month average of this data. So all that's listed on your commercial credit reports as well. That's the history of how you've paid your bills in the past. So it normally also contains business background data, okay, which we've talked about before a little bit earlier. If you have a family tree, for example, it's here. Your SIC filing information is down here. How long they've had your business on file is down here as well. So any background data, financial information, and that really has to tie into this score right here called a financial stability score. And the financial stability score basically depicts depicts your risk of going late based on the financial health of your business, and it takes into account things like your Intelliscore, how you pay your bills. But what's interesting is it also takes into account one of two things. Either one, if they have it, your tax returns, your financial data per your tax returns. Business credit, very different than consumer credit, because with business credit you can supply them the tax returns. You can voluntarily choose whether they should have your tax returns or financial data or not. And that's what they're using to primarily calculate the score. If they don't have this, they divert to the number of employees you have. And that typically comes from your Secretary of State. And you're automatically a very high risk if they don't have any of that data about you whatsoever. Let me see if I can find one of those where you can kind of see that really, really, really high risk. Here's one where they don't have any data at all. And you can see the risk score is very, very high, about as high as you can go. So when they don't have any financial data and no payment performance, they immediately put you as a very high financial risk. Almost, this is meant to determine if you're going to file bankruptcy or not. You're almost as higher risk as you can get in filing bankruptcy when they have no information about you. As you start to acquire some payments, then that score comes up pretty quick. You'll come up to a middle to low risk type category. If they have tax returns, that's when they can start to move you into a low risk category, when they start to have some financial numbers and know that you're generating revenues and profits. And if they don't have that, again, what they'll typically do is look at the number of employees you have. And you can see right here, number of employees, 3. So on commercial credit reports, the number of employees you have will be used to judge your business in lieu of revenue. If they have revenue per your tax returns, they put it right on your business credit report. You'll say it has a section that says business facts. It lists your sales, how much you generate in revenue, and that figure is primarily used to drive this financial stability score. And then if they don't have it, they again divert to number of employees. So the lesson to be learned here is twofold. First of all, get your tax returns when you have them to the reporting agencies. That's going to help make you an overall lower financial risk, especially if those reflect pretty good revenues and some profits. Secondly, be wary and be cautious of when you enter the number of employees you have on the applications and with your Secretary of State. Know that that data will directly translate to your business credit reports. A lot of people don't think about this. You file that annual report, you go through it in 1 to 2 minutes and just refresh the data and send it in. Well, the number of employees you have from that annual report could directly translate here to your business credit report, and can be used to judge your financial stability of the business. So keep those things in mind when you're providing that information on applications. Credit score and risk factors, which we just talked about. Banking, trade, and collection data, which we talked about. Liens, judgments, bankruptcies, UCC filings. So all a UCC filing is it just an indicator that you have an outstanding loan. It's not a good or a bad thing. It just indicates that you have an outstanding loan. So you got to be careful here when you get loans and they tell you they report to the reporting agencies. What are they reporting? Are they reporting only if you go into collections? Are they reporting a UCC filings? Neither one of those will help your scores. Or are they reporting your actual payments? The payments will affect your score. So something you should talk to lenders or credit issuers about when you're applying. So let's talk a little bit about Experian's main score there, Intelliscore. Ranges from 0 to 100. 0 represents a high risk, which is bad. 100 represents a low risk, which is good. And the 0 to 100 is a percentile score. Basically, it reflects the percentage of business scoring higher or lower than your business in a specific industry. So again, this is very interesting. All the reporting agencies have it. They have what's called percentile scores. And whenever you hear that word or see that on a business credit report, you should know that what they're doing is they're rating your business compared to other businesses in the same category. Okay, so they have scores that judge your risk overall and scores that judge your risk compared to other people in your industry. So why does this matter? Well, let's look at restaurants. Restaurants inherently are very high risk industries because the majority of restaurants fail. The failure rates in the restaurant industry are significantly higher than almost any other industry that exists for businesses. So as a result of that, they already know that just because you're in the restaurant industry, you're high risk. So they are going to judge you against other restaurants in your industry because it might reflect that you're performing and paying way better than the rest of them, and you should be judged accordingly. Just because you're in a high-risk industry doesn't mean that if you're performing way better than everybody else in the industry that you shouldn't get credit for that. So that's what percentile scores do. Percentile scores will look at where you compare to others in your industry, and then it basically gives you that direct comparison. And you can even see on business credit reports that there's this kind of language even worded. So for example, here's a quote from the business credit report: risk associated with the company's industry sector. So just because of the industry, that determines that you're higher risk. But if you're looking at a percentile score, it would be comparing you to other people in your industry. It wouldn't hold it against you that you're in what's deemed to be a higher industry risk. And here's even more what's interesting. It says on the credit report, industry risk comparison. 79% of businesses indicate a higher likelihood of financial stability risk. So here's that percentile score. And what it means is it means that you're being rated against other businesses. And in this case, 79% of businesses indicate a higher likelihood of financial stability risk. So that means that you are better than 79% of other businesses in your industry. So here we go. We look and we see that this business has an 80 score, and that means that you score better than 79% of other businesses because you're an 80. If you were a 90, you'd score better than 89% of other businesses. So again, there's a comparison between where you are overall in risk and where you are in risk compared to other businesses in your industry. So Intelliscore, as I said, is widely used. It's used by financial institutions around the world, primarily used by credit issuers. A lot of credit issuers use this score. So do over half of the top P&C insurers and most major telecommunications and utility firms. So when you go to get utilities for your business, when you go to get phone service, when you go to get insurance, a lot of them are looking at Experian reports and Intelliscore. Industry leaders in transportation, manufacturing, technology are known to use Intelliscore as their primary risk indicating model. So again, transportation, manufacturing, technology, insurance, All these industries are heavily relying on this Intelliscore provided by Experian. So Intelliscore Plus has more than 800 aggregates or factors. This affects business credit scores, and scores again are assessed on the millions of companies that Experian has on their record. So what does it measure? Well, it's a highly predictive score which provides a detailed and accurate reflection of a business's risk. So it predicts a risk of going over 91 days late. Look, all of the main business credit scores, Dun & Bradstreet's Paydex score, Experian's Intelliscore, Equifax's credit risk score, those are their main scores in the commercial world. All of them are used to determine your risk of going over 90 days late over the next 12-month time period, okay? So this good thing about this is that consumer credit scores look at your risk of going late over the next 2 years. Business credit scores look at your risk of going late over the next 12 months. Why does this matter? Because it's easier and more forgiving to build business credit than consumer credit. Since they're only looking at what you plan, what the risk is over the next 12 months instead of 24, then it becomes easier for you to control the scores, because even if you make mistakes, even if you go late, even if you damage the score, by paying your bills beyond that point on time and as agreed, your score can rebound much quicker than consumer credit. This is one of the many, many reasons I love commercial credit world versus consumer credit world. It's easier to build business credit scores. It's faster to build them because they're only based on how you pay, and they're more forgiving. If you make mistakes, you can start paying other bills as agreed or early, and you can quickly make up ground and increase that score faster and easier than you ever can with consumer FICO scores. So Intelliscore Plus is still based on payment history of a business. However, there are other factors, and these are the things that we just briefly talked about earlier. The historical behavior or payment history makes up the majority of the actual or makes up 5 to 10% of your overall score. Okay, current payment status. Basically, how are you paying? Late, behind. Trade balances and percent of accounts delinquent will account for 50 to 60% of the score. Now, remember, although this sounds like a lot of different factors, all we're really talking about here is payments. What they're saying is 50 to 60% of the score is made up of your current payment status, your current balances, and the current percent of accounts delinquent. Okay, the historical behavior, what's happened in the past, only accounts for 5 to 10% of the way. So only a tenth of the overall percentage here has to do with what you've done in the past. The rest of it's applying to what you're doing now. And again, that's what's nice about business credit. It's more forgiving than consumer credit, because if you make mistakes in the past, it's easier to recover because what you're currently got going on weighs so heavily into the overall score. Your utilization affects 10 to 15% of the overall score. What's interesting about business credit reports is they don't show limits. They show the recent high credit you've used. So this matters a couple different things. First of all, you've got to get the credit and use it. The more you use the credit, the more future credit issuers see you're using it, and the more they have a desire to lend you money because they see you actively using credit. But you also need to know that credit issuers and lenders, they can see your limits. You will not see the limits on the reports. It doesn't mean that they're not reported to lenders or credit issuers. It just means you won't see them. You'll only see the recent amount of high credit that you've used, but your utilization does affect 10 to 15% of it to Experian's Intelliscore. Now, the company profile, age of the business, industry, risk, and size of business as assessed by number of employees has to do with about 5 to 10% of the actual total score. Okay, so that being said, you know, there are other factors. How long have your business been open? What industry are you in? How many employees do you have? As we've talked about and looked at what those things look like on reports, that does affect about 5 to 10% of your score, which is one of the reasons I talk about high risk industries, because high risk industries can prevent you from or not prevent you, but can hurt your ability to build business credit scores. It's a small factor, but it still is a factor. And 10 to 15% of your score is determined based on derogatory items, liens, judgments, collections, tax liens, bankruptcies. So the bottom line is, about 85% of your score is some variant of how you pay your bill, how you did it in the past, how you're paying it now, collections you've had, etc. The other 15% or so of the score has to do with things like your industry and your utilization, etc., etc., etc. So where does Intelliscore data come from? Well, it comes from credit obligation information from suppliers and lenders, basically stuff that's voluntarily supplied to Experian from the people that are issuing you credit. It also comes from legal filing, stuff with the local, county, state, government levels that they find judgments, tax liens, lawsuits. Company background information from independent sources. This comes from utility providers. It comes from insurance sources. It comes from all those places when you're supplying your business data to get your electric turned on and your phone turned on and all those type of sources as well. And it also includes state filing, public records, collection agency, credit card company data. Looks like I went off the slide here. And financial information provided from other databases as well. So basically, the reporting agencies are very good at scouring anywhere they can go to get information and put it on your report. Payment experiences, again, information that's supplied to them, public records, collection, company background data with any information they can get from Secretary of State records, et cetera, et cetera. That's also going to be on your report. Now, they also have, again, the Financial Stability Risk score, which we talked about, potential of going bankrupt. They refer to it as several things: potential of going bankrupt, potential of ceasing operation, potential of stopping paying all of your bills. Okay, that's what that is. The score identifies the highest risk businesses by making use of payment and public records, which include delinquent payments, high utilization rates, tax liens, judgments, collection data, risk industries, short time in business. And again, they're also looking at other information as well. Your tax returns, as we talked about. We already referenced here the number of employees that you have. These type of things calculate into this score as well. So really what this does is it takes into account everything Intelliscore does, which we've already talked about: judgments, tax liens, collections, utilization, payments, and then it also takes into account your financial data as well. Here's that blended score that we talk about. It's a one-page report that provides summary of the business owner and the business information. Okay, it combines the two and puts it into a specific score using your business and your consumer information. Now, for troubled businesses, blended scores drop an average of 30% over the 4 quarters leading up to a bad event, which means them going late. And this is Experian's own number. So if you want to know why they would ever combine a blended score, a business and a consumer score, here's their own metrics to support the reason why they do that. Because what they find is that blended scores drop significantly right before a serious event occurs, which is why they believe these are very form of accurate information. The owner's consumer scores showed no statistical significance in the decline, and 50% of the time, the first signs of credit problems were on the business credit report. So what they're saying here is, hey, look, if you pull a business owner's credit report, then in a lot of cases, those have no historical relevance of showing that a business may go late. But when you combine the two, then they find that the scores do reflect a likelihood that the business may go late before it actually goes late. And again, they're saying that a lot of the signs that a business goes late appears on the business reports, well, as part of the time it's on the personal business owner's credit report. So by looking at both, they feel it gives an accurate depiction of whether or not the person will go late or not. So the blended scores have been found to outperform consumer or business alone by 10 to 20% per experience. So why aren't they used, right? Because we talk a lot about building business credit without your personal credit being looked at for a reason. This blended score is something rarely ever you'll see. You'll rarely ever run into this blended score. So why is it so rarely used? Well, I can tell you one of the reasons is because they don't need your permission to pull your Intelliscore. They don't need your permission to pull your financial stability risk score. Anybody that wants those scores can get it without your permission. But the minute they need to tap into your consumer credit score, that's when the Fair Credit Reporting Act comes in. And then when the Fair Credit Reporting Act comes in, that opens up to credit disputes, that opens up to credit repair, that opens up to all the compliance regulations regulations that the FCRA has, including the fact that they have to have you sign and give permission for this. So you'll rarely ever see this score because they don't want to or get your permission. How will you know? They'd have to get your permission to pull your consumer credit. And if you don't give them the permission, they could never pull this blended score. And they typically don't want to ask for it, which is why they don't even bother with it to begin with. So how long do items stay on your commercial credit reports? This is a pretty big deal because it's different with Experian than it is with Dun & Bradstreet and Equifax. And this is a question that I get a lot. Well, trade data stays on there 36 months. Bank government leasing data, 3 years. Uniform commercial code filings, UCC filings, 5 years. Judgments, 6 years and 9 months. Tax liens, 6 years and 9 months. Collections, 6 years and 9 months. Bankruptcies, 9 years and 9 months. So if you've ever been somebody that's asked me this question, which I get a lot, how long does data stay on my commercial credit reports? And I give you a convoluted answer that it varies depending on the type of account and reporting agency. Now you know why I don't keep all this to memory, because it's different with every reporting agency and every individual type of account. Let me get this closed down. Every different type of account and every different industry, or every different type of account and every reporting agency is different with this. So it varies greatly, as you just were able to see. So this is how long stuff stays on your business credit reports with Experian. So make sure vendors are reporting your payments, okay? This is the thing. A lot of people we talk to think they have business credit established. We pull their business credit reports and they don't have any because they're getting credit with vendors that don't report. Get credit with vendors that do report to the reporting agency. It's an easy way to improve your Experian scores. The more vendors which report a positive history, the better you are, and the more you are protected against a negative event. The best way to prevent your scores from going down when you have a derogatory item is to have a bunch of positive items that offset the derogatory item. That way you can still have good scores. The higher your business credit rating will be, and not just with Experian, as long as you continue to pay those bills as agreed. Remember, 85% of Experian's Intelliscore is based on how you pay your bills. 100% of Equifax and DMB's credit score, 100% of DMB's PAYDEX score, and Equifax's credit risk score has to do with how you pay your bills. So the one thing you have to do to get good scores is make sure that you're paying those bills on time or early. Okay, improving your score is not a great mystery. Pay your bills on time. Pay them in full. Okay, try to maintain your balance at about 20 to 30% of your limits at highest. So if you can, don't carry revolving balances. It don't hurt you severely if you don't. As we talked about, utilization only affects about 10 to 15% of the total score. But still, try to keep your balance as close to zero as possible if you can, because that will help maximize your score. Not as important as paying your bills, but it will help. Don't close positive accounts. Try to avoid derogatory. And I'll add one more to this. Not only don't close positive accounts, but continue to use your accounts, okay? A lot of these accounts are use them or lose them. So, for example, we had a client that lost a $12,500 Apple account because they didn't use the account. And Apple doesn't want to keep the credit extended if the person's not going to use it, so they shut down the account. So it's not enough just to get credit that reports to the business credit reporting agencies. I see so many people make this mistake. They're trying to build business credit to just build business credit. You don't want to do that. You want to get credit you're actually going to use to grow your business and continue to use the credit. That's the key to building good business credit profiles and scores. And the key for other lenders and credit issuers to see your ongoing using your credit, which is what opens up the doors for them to lend you more money. Okay. And try to avoid derogatories like liens, judgments, public records. If you get mad at somebody, maybe consider another alternative other than filing a lawsuit. Because if you file a lawsuit, even that shows on your credit report as an outstanding lawsuit. And again, they'd have to dive deeper to even see if you were the one that was the defendant or the one that's actually serving the lawsuit. So Experian offers monitoring services, Business Credit Advantage, about $129 a year. They have a Business Credit Score Plus, $175 a year. Profile Plus, $49.95 for a single report. That's what you want. If you're going to go to Experian direct and pay them, you want to choose the Profile Plus because the others are just giving you score access. You don't want score access. You want to know what's actually on your report. And again, If you go to creditsuite.com/monitoring, you can get right in through our nav integration and get Experian and DMB together for only 24 bucks a month. So it'll save you some money. Credit score report, $36.95. You don't want that stuff. That's just scores. You want the actual report. And again, you can monitor your credit directly with us through creditsuite.com/monitoring for only 24 bucks. So let's kind of give an overview here. Experian reporting combines personal and business data with the blended report. But again, that's pretty rare. You're not going to see a lot of that. Handling credit responsibly on both personal and business sides will help assure high scores. Paying your bills on time. And Intelliscore is primarily based on how you pay your bills. But there are some other things like balances and the percentage of delinquent accounts and other factors as well, such as your industry, the size, things like that. And remember, if you do go late, it will be on your credit report for 36 months if it's a derogatory item, but your score only looks at your risk of defaulting over the next 12 months. So the best thing to do is to make sure you have enough positives to offset the negative. That's a good way to overcome any kind of negatives that are on your business credit reports. Have any questions? Then give us a ring. We can't actually answer them on our iTunes, on our podcast, or on our YouTube live, although we do go live on a lot of Wednesdays at 4 o'clock Eastern where we do answer live questions. So if you have questions, email us, info@creditsuite.com, or give us a ring at 877-600-2487. That's 877-600-2487. Don't forget to visit creditsuite.com. And at the top right of the page, you'll find our social icons like Instagram and Twitter, where we're sharing a bunch of posts usually daily. Facebook, where we're sharing a bunch of content. We go live typically about once a week. Our iTunes channel, and as well as our YouTube channel, where you can get hundreds of different videos and audio clips on the go to be able to learn more about getting commercial credit, building business credit, and also about obtaining all different kind of business financing. So now you know the ins and outs. We've looked at Experian's actual credit reports. We've talked about all the different sections, what's on there, the scores you'll see, how the scores work, the things you need to do to maximize your scores, the things to do if you have bad items to overcome the impact on your score. So now you are in control. Now you know the things you need to know to make sure you can maximize what's on your business credit reports with Experian and your Intelliscore, which will help you get approved versus denied and also help you get the most amount of money and be able to do so at the best terms. Thanks for tuning in. If you have any questions, feel free to give us a call, 877-600-2487, info@creditsuite.com. And don't forget to visit creditsuite.com for a ton of cool information and also for our social channels as well. Thanks, everybody. Have a great day.